We're here today to talk about a client of ours, Primary Health Properties, and more specifically the retail bond issue that it's raising at the moment. Obviously, we're just giving a view on the companies. Any investment decisions, you've got to look at your professional advisors. PHP, what does it do? It's investing 100% of its money into newly built GP surgeries, and this bond is partly to do with management of PHP's debt. It's also been doing fundraisings in the equity market, 16 million share issue in April. It renegotiated some of its facilities, 27 million, about 5 months ago. But we very much welcome the effect that this issue that it's raising at the moment is going to have on PHP's business. So what does it do and why do we like it? The leases in this market are typically 25-year plus, so very long-term leases. And the first key issue is that they are upwards only. So it's not like what you're getting in some other areas of the real estate market. Occupancy is 99-100%. And the second key issue is that the government underwrites the rent. So this is blue chip stuff. So the bond itself, we think it's an interesting one because it does offer a yield pickup compared to similar ones that we will talk about later on. So PHP's driver is health. It's specifically doctors' surgeries. 44% of the UK's population has got chronic disease. That's up from 33% only 10 years ago. And 80% of primary health costs go to that cohort. Much of those costs actually can be addressed by pharmacies rather than going to hospital and so on and so forth. And that brings us to the PHP estate. Of the primary care estate, this is effectively GP surgeries, 40% are purpose-built. It would be better if it was more, but that could be worse. But 80% are considered by the GPs themselves to be too small. The key issue is that only about 5% have got a pharmacy co-located with the doctor's clinic. And this is increasingly important. So all that means is that PHP and certain competitors have a government really keen to expand the GP surgery estate with larger, well-located, typically with pharmacies and the sort of outfits that you can have x-rays, blood screening done that at the moment are done at hospitals at much greater expense. So PHP's laid out pretty clearly a growth path. It's looking to invest about 50 million a year into new assets. So the money that it's raising here and elsewhere will be invested in fairly short order. There's room for this new money. What's the effect on profits? It's buying assets, the surgeries, at near 6% yields, and that translates with just a small fraction over 5% after all the overheads and costs that you have in managing those assets and in the fees in running it. Debt overall for PHP is costing about 5.5%, falling to about 5.1% a couple of years down the road as cheaper debt, newer debt kicks in. And by the way, we add in all the costs of the bank swaps on this to be a sort of technical issue. But the rents are rising, and remember it's upwards only, they're rising at about 2% a year. So very, very soon, within a year or two, you're getting positive cash, more coming in from the yield on the rent than you are paying for debt. And obviously you only pay for part of the assets by debt. So there's a really strong visibility, strong cash positive, really visible profit growth, and there's profit week in, week out. It's not like every year, there's very regular profit growth. The yield on the shares themselves is 5.8% and the dividends are rising. They're rising because we've got that great visibility of them buying assets that are yielding pretty well and debt fairly cheap. So this specific bond is costing around about 5 3/8%. It's 7-year money and they're looking to raise 75 million quid. That is a higher yield than some of the peer group. So the peer group would be Places for People, for example, which is a housing association. You only get a 3.7% yield buying that in the market at the moment. A real estate company, a very large one called Segro, they've got a 2018 bond and that bond's yielding 3.8%. They've got a 2022 bond which is yielding 4.7%. So those are all quite a long way below the 5 3/8% of PHP. One of the differences is that PHP isn't credit rated. The others do have a Fitch style credit rating. Is that a problem? Well, I think that with the strength of the assets and the visibility that we've just been talking about, they may well in the future in any case get a credit rating, which would be, I would think, let's not sort of prejudge this too much, but I would think it would be a pretty strong one. And in any case, investors can take a view on the visibility of these 25-year, 30-year leases. So you've got a yield pickup and quite probably the risks aren't higher in these bonds than in the other peer group that I mentioned. So it's a good opportunity there. And if they do have a credit rating in the future, that should help the rating generally of all PHP's debt. So why are they doing it? They're doing it to bring in unsecured money. They're not tying this debt to any specific properties. So if they see that there's a lump of assets that they want to buy, they'll be able to buy them and then sort out the debt in the longer term, asset by asset. It gives them much more flexibility to buy mini portfolios, stuff like that. Just touching on the shares for a second, how pricey are they? Well, the yield, as I said, is a great 5.8%, and they do make profits, each quarter, not just on a long term. It's very regular, and they're trading at pretty much exactly 100% of EPRA NAV. In 2009, 10, and 11, they traded on 95, 96, and 100% of EPRA NAV. So on that basis, they don't look cheap, they don't look expensive compared to what they were in the past, but they've got a really great yield. And of course the key issue is, where do they go in the future? Well, we have modelled about 10% physical growth per annum from this funding and their own retained profits, and the NAV growing at about 7% a year, NAV per share. There's one issue though, in that the valuation basis for these doctor surgeries is around about 5.96%, and we consider them to be as near as you can get to pretty decent primary, very top class blue chip assets. And you've got A-grade assets that tend to be rated more at sort of 5.25%, 5.1%, 5.3%. So there is scope, we think, in the long run. We don't see this happening short term, but in the long run there's scope for the assets themselves within the portfolio to be re-rated, and that obviously would have a positive effect on NAV were it to happen. Looking at the bonds have got the 5 3/8 yield. Okay, is that interesting? Is it not? We think it's reasonably attractive. We also think that given that there is that scope for them to trade at a premium to 100%, and if you look at the Places for People and the Sacro bonds, they're all trading at a premium. We don't know whether they will, but we've given some views as to why perhaps there's drivers that would be looking positive. That would obviously add to the returns. We don't know when that re-rating would happen, but we think that the risks are on the upside, and in any case this is an interesting sector to look at.